Welcome back to Smart Dollar Mindset, the channel that helps you achieve financial freedom through smart money habits and investing. Today, we're diving into one of the most exciting topics for income-focused investors: monthly dividend ETFs that pay you to wait. Think about this for a second. Imagine getting paid every single month just for owning an investment. Instead of waiting 3 months for quarterly dividends, or even longer, you could see consistent cash flow hitting your account 12 times a year. That's the power of monthly dividend ETFs. These funds can be a game changer for retirees, people looking for passive income, or even young investors who want to reinvest dividends for compounding growth. In this video, we'll break down what monthly dividend ETFs are, how they work, the pros and cons, and the most popular ones in the market right now. We'll also go step by step through strategies you can use to maximize their benefits, while avoiding the common pitfalls that trap many beginners. Stick with me to the end, because I'll also share how you can integrate monthly dividend ETFs into a larger wealth building plan, so your money isn't just sitting still, but actively working for you while you wait. What are monthly dividend ETFs? Let's start simple. ETFs, or exchange-traded funds, are baskets of securities, like stocks or bonds, that trade on an exchange just like a stock. Instead of buying one company, you buy a collection of them. Now, dividend ETFs focus on companies that pay dividends. And some of these ETFs distribute dividends monthly, instead of quarterly. That means instead of waiting 90 days, you're seeing cash flow every 30 days. Why is that powerful? Because it aligns with how people live. Bills, groceries, mortgages, they're monthly. So an investment that pays monthly can feel more natural, especially if you're using dividends to cover expenses. Why monthly dividend ETFs are attractive? There are several reasons these ETFs are so popular. Cash flow consistency. Monthly dividends make it easier to budget, especially for retirees who rely on investment income. Compounding power. If you reinvest dividends every month, you're compounding faster than waiting 3 months at a time. Psychological benefit. Getting paid monthly feels rewarding. It keeps investors motivated and reduces the temptation to sell. Flexibility. You can choose to reinvest or take the cash. That flexibility is valuable in different stages of life. Step 1. Understand the structure of monthly dividend ETFs. Before investing, you need to understand how these ETFs generate the income they pay you. Some invest in dividend-paying stocks, like large companies with strong cash flows. Others invest in REITs, real estate investment trusts, preferred stocks, or even covered call strategies that generate income through options. Example, a fund like Global X Super Dividend ETF, SDIV, invests in high dividend-paying companies worldwide, while a fund like JP Morgan Equity Premium Income ETF, JEPI, uses options to generate additional monthly cash flow. Knowing what's under the hood is critical. Because not all dividend income is created equal. Some is sustainable. Some isn't. Step 2. The trade-offs of high yield. Here's something important. Higher yield doesn't always mean better. It's tempting to see an ETF paying 10% or 12% annually and think, wow, that's amazing. But often, high yields come with high risk. A yield that's too high may signal that the fund is taking on risky assets, or that its share price has dropped significantly. Sometimes, the dividend may not even be sustainable long-term. Example, a fund yielding 12% might look attractive, but if the underlying stocks keep losing value, your total return suffers. Always remember, the goal is not just income, it's income you can count on. Step 3. Popular monthly dividend ETFs to consider. Let's look at some of the most well-known funds in this space. JP Morgan Equity Premium Income ETF focuses on large U.S. companies. Uses covered call strategies to generate extra income. Known for stability and a strong monthly payout. JP Morgan Nasdaq Equity Premium Income ETF, similar to JP, but focused on Nasdaq stocks. Offers growth exposure with monthly dividends. KILD, Global X Nasdaq 100 Covered Call ETF, uses covered calls on Nasdaq 100. Very high yield, but limited upside growth. RILD and ZILD, Global X Russell 2000 and S&P 500 Covered Call ETFs, same strategy applied to different indexes. Designed for income investors. Realty Income, technically a REIT, but famous as the monthly dividend company. Owns thousands of real estate properties. Pays a reliable monthly dividend. Each of these comes with pros and cons. Some prioritize stability, others maximize income. Step 4. How to analyze a monthly dividend ETF before you invest. Here's a framework to analyze any monthly dividend ETF. Dividend yield, how much is it paying annually? Expense ratio, how much does it cost to own? Fees eat into returns. Underlying assets, is it stocks, real estate, or derivatives? Performance history, has the payout been consistent? Risk profile, is it volatile? Does the dividend look sustainable? This step ensures you're not just chasing yield, but building a stable foundation. Step 5. Strategies to maximize monthly dividends. Here are some practical ways to use these ETFs. Dividend Reinvestment Plan, DRIP, automatically reinvest dividends each month. This builds compounding power. Hybrid strategy, combine growth ETFs with dividend ETFs for balance. Income replacement, if you're retired, use dividends as cash flow for bills. Tax optimization, hold high-yield ETFs in tax-advantaged accounts when possible. Example, reinvesting $500 per month in a dividend ETF that yields 8% can turn into over $75,000 in just 10 years, without adding a penny beyond the initial investment. Step 6. The downside risks. You must know it's not all sunshine. There are risks, market risk, share prices can fall, even if dividends continue. Dividend cuts, companies or funds can reduce payouts. Opportunity cost, high dividend funds may miss out on long-term growth. Tax implications, some dividends are taxed higher depending on the account type. Being aware of these helps you prepare and diversify. Thinking long-term. Here's the key mindset shift. Monthly dividend ETFs aren't about getting rich overnight. They're about building consistent, reliable income while you wait for bigger opportunities. They let you stay invested, stay patient, and still get rewarded along the way. Final thoughts. Monthly dividend ETFs are powerful tools for investors who want steady cash flow and the discipline of consistent returns. They bridge the gap between long-term investing and short-term needs. But remember this, dividends alone don't make you wealthy. They're part of a bigger plan. Real wealth comes from a mix of income, growth, and smart money habits. When you invest in monthly dividend ETFs, you're not just buying income, you're buying time, patience, and consistency. You're giving yourself a reason to stay invested when the market gets rough, because you know you'll still get paid. And as those dividends roll in month after month, reinvested or spent wisely, you build something even more valuable than money, financial freedom. So whether you're 25 and reinvesting for growth, or 65 and relying on income, monthly dividend ETFs can be a key part of your strategy. But never forget, don't chase yield blindly. Choose wisely. Diversify. And always think long term. If this video gave you value, subscribe to Smart Dollar Mindset. This channel is here to help you achieve financial freedom through smart money habits and investing. Together, we'll keep learning, growing, and moving closer to financial independence.